Well, hey everyone, John Chapman at WorthPoint Wealth Management. Welcome to my humble abode. You're in the master bedroom with me right now, thanks to coronavirus work from home. So here we are. Today I've got four of my most favorite slides to talk to you about, and I really want to address the question, should I use a stop loss for my stocks in my brokerage account? Of course, the market's been super volatile, and whether you're holding just an IRA account or an old 401k, or maybe your brokerage account with your various stocks, it's hard to feel like I want to do something and not exactly sure what to do. So I've had the question really recently come up from actually quite a few people, friends and clients alike. And they should ask, should I set some limit to the downside? If the stock market were to go, then my trigger will be executed. It'll sell me out of the market, and then maybe I can prevent some of my losses. I've got four awesome charts to go through a little bit of the data, and then I'll share my personal feelings. Obviously, know the disclaimer, I don't know the future of the market. I don't know what's best for you. You need to speak with a financial professional. And if you don't have one, then you can always reach out to us. Let's dive into what the data says. Okay, here we are, chart number one. Want to look at the distribution of the daily market returns over the past 30 years or so. Meaning this is showing on any given market day, what percentage did it move? Did it move up a 0.5%? Did it move up 1%? Did it go down 1%? And what this chart is showing us is that this huge cluster, 95% of the time, two standard deviations, 95% of the time, the stock market moves less than a 2% range, less than positive 2% and less than negative 2% on any given day. So there's a little over 220 trading days every single year. Over the past 30 years, it's quite a lot of data. And yes, we certainly have had some volatile swings most recently, but to set some expectations, if you're trying to think about what's a day-to-day market up or down swing look like, it's really clustered within this range of positive 2% and negative 2%. Beyond just the day-to-day swings, what about if we consider the yearly swings? Again, in 2020, we've had way more than positive and negative 2% in any given days. What this chart shows right here, again, similar data, but a little bit longer time set, going all the way back to 1970. It's the S&P 500, and it's the yearly gains in these blue bars, but then the intra-year gain or decline in these black bars. The big takeaway that I want to guide you to is to this downside right here. So at some point in the year, if the market fell from its high down to some low and then regained it, basically the average is about 14%. So on average, maybe you see on day to day, the market moves a little bit under 2%, but within a year, the average, there could be a swing of about 14%. So now that just begs the question, if you are going to use a stop, where do you put it? If you're looking at a stock that you own and you have some hefty gains, do you set it on maybe 2%? Do you set it down maybe 14%, knowing that in any given year it can do that? It just presents a lot of problems. My next favorite chart is to show you what the yearly returns look like. And basically, over the past almost 100 years of data, there's almost a 74% chance that in any given year, the stock market is going to end positive. Can't extract this out into the future. I don't know what the history was going to hold for us, but it's certainly the odds have been in people's favor of continuing to hold their stocks rather than to set some stop loss limit in the bottom. And really, this gets to my absolutely favorite chart right here. And this shows us what the risk that we're running. If we don't put a stop loss in, the risk that we run is that the market could go down very quickly and we could not recover from that, or it could take us a long time. But the flip side, we also run a big risk if you do use a stop loss. And what this chart shows is if you were invested over this 30-year period, and let's say you had $1,000, if you stayed in the stock market that whole time, your $1,000 went to almost $17,000 if you were in every single day. And if you missed just the best 15 days, your $1,000 only grew to $6,000, a fraction of the total return. And so if you put a stop loss, the market goes down, well, you might actually end up missing out on one of those 15 best days or something like that after the market's been down. And so you're not getting any of the upside. And boy, you are significantly hampering the potential of your upside return. All right, gang, we've shared my four most favorite charts. The first one about what the daily move is on average in the stock market. And again, it's around +2 or -2%, 95% of the time. We also looked at my second most favorite chart, which shows just on average the intra-year decline. And most often the market goes down around 14% or so any given year. And then the third chart we looked at just shows that over the past 100 years, there's been a big skew to the market ending the year positive, almost 75% of the time. And then my last chart, if you really do miss out on the big days, that can create a big difference. So my feeling is that most folks that use a stop loss end up running a bigger risk of not being there for when the market gives us those big up days. And probably what's more important is finding some mix of stocks and bonds. That's your asset allocation. And that's going to be what you're comfortable with to weather both the good and the bad. If you don't have a financial advisor, be sure to reach out. We'd love to be able to talk to you about your specific situation. Again, none of this is advice, just education. I hope you feel more informed and more empowered to take action on your allocation. And best of luck investing. We'll see you again next time.